I got to fix that one day. Well, this was a good idea then. Look at oil, 58.50. Holy cow! We only had this one bounce over here. That would have stopped us all out though. It was 59. Let's see what we had before that. That's pretty much straight down. Otherwise, there was almost no bounce all day. Just down and down. See this bounce from it touched. It was never quite got below 60. Didn't make it back to 60.25. We were setting 25 stops. So the only significant pop we got. You can get the arrow to do that. Oh, it's over here. No wonder it won't do that. So this is the only significant pop we got. It popped off 59, back over 59.25. So that was a stop out right there, which is what I think I said at the time, 59.25. But that was a nice chunk of change. Otherwise, the index is looking pretty good shape. The NASDAQ is down. People are still rotating out of the high-flying tech stocks as we think they should. But that doesn't mean I'd be jumping right back into the other stuff because actually the Dow's gain right now is almost all Goldman Sachs and probably half Goldman Sachs. So 400 points up on the Dow. But let's take a look at Goldman Sachs. GS. Yeah, 22 points. And so you take 22 points, calculator. So it's 22 points times 8.5 is the thingamajig. So 180 something points. So yeah, about half the Dow's gains are coming from just Goldman Sachs popping 22 points. So that's how you figure out like what the influence is of a Dow component and such. So, the Dow's up 200, which is 1.25, 1.3 or 4%. Not terrible, but it's not as glorious as it looks on the charts. Always have to be careful about that stuff. Take a look over here. Actually, you know what I haven't done is I haven't looked at the other thingy, the heat map. So today you can see what's happening, and here's the Magnificent Seven, basically. These giant son of a bitch companies are all red, and basically everything else is green. Money's coming out of them and going into other places, unless you are an energy company, unless you're in real estate. Even and you see how the actual industrials, don't forget the Dow Jones Industrial Average is no longer industrials, but the actual industrials are not doing so well. The discount stores, not particularly good. The household stuff, not particularly good. So what is good? Healthcare, oof, wow. Banks leading the way. Credit services. JP Morgan getting into the Bitcoin, not Bitcoin, but into the stable coin business. So, whoever pulls off that scam is going to make a lot of money. Got credit services, insurance companies, because the hurricane season has been a bust this year. Not really. No major catastrophes in the U.S. for hurricanes. Capital markets, of course, the big guys. Asset management is always good. Insurance is good. Banks, more insurance. Financials, and drug manufacturers, thanks to Trump's new plan to get everybody in the country on Ozempic. They like that. Bodie pointed that out last week. It's like, well, okay, they're not really cutting the price because they already, get cut. Their prices have already been cut by the insurance companies. It's only the government that doesn't negotiate the prices. But now Trump is going to allow Medicare to pay for your Ozempic. It's going to go down, or not go down, but I mean, people who never had it before will now be able to have it. And he'll collect a ton of money, and everybody will be on Ozempic. Like 50 million people are going to end up being on Ozempic versus you know, about 20 million people now. So they're going to sell a lot more drugs, a lot more weight loss stuff. There's a logic to it because hopefully, if you do get everybody on Ozempic and then the country is slimmer and thinner and healthier, that'd be good. This is going to have a very negative consequence, though, to fast food places. So that's something we could look at for shorting purposes. We're already worried about the Cheesecake Factory. They better turn into the wheatgrass factory or something, because they're heavily reliant on liquor sales, and they have a fairly fattening menu, especially the cheesecake. So if they lose their dessert sales and they lose their liquor sales, what's going to happen to them? That's what you got to think of. So, you know, people are drinking less. That's also a function of the weight loss drugs. Because what it does, it's more of an addiction killer. You know, the Ozempics and whatever, they're more of an addiction killer. And so alcoholism also, you know, your desire to drink goes down with your desire to eat food. So I don't know if water, I don't know if it works on water. I hope they're flushing themselves, these people. But you got to think of consequences in these sectors. See, and then they'll tell you, well, you know, we know the consumer's in trouble, but then they'll look at that and say, oh, the consumer's very weak because the restaurant, blah, blah, blah. But then you really got to start digging into numbers and saying, is it because 10% of the people are no longer eating out 3 times a day? You know, is it because people are cutting back? And then you say, well, they got to eat something. So what are they eating? Anyway, oil and gas, not doing good. Not a good sector right now. Real estate, not a good sector right now. Diagnostics is good. Medical anything is good. Biotech is good. But that's a day. How about a month? Haha. So for the month, these guys who are down today are, other than Meta, who's really got problems because their AI is going to be a bust. Generally, we're okay on the 7, on the big tech. This is the monthlies, don't forget. So, you know, you see these numbers. Financials, JPM, very good. Visa and MasterCard, not so good, but American Express is booming because they cater to rich people. Capital markets are doing good over the long run. Asset management, not so good for whatever reason. Insurance is not good. Insurance brokers are not good. These are the brokers, not the actual companies. That's an interesting thing. Consumer defensive has not been very strong. All the consumer stuff has been pretty weak. Packages, Warren Buffett always says, watch those packages. Oh, that was not packages, it's packaged food. Sorry, different. Travel services, home improvement, poor Home Depot, Netflix, T-Mobile, Comcast not having a good month. So we're going to take this data and then we got to line it up with who's performing. What are the earnings? What's going on over there? And here's Bodie's report. Earnings season comprehensive AGI level research report, executive summary. Q3 earnings has delivered exceptional performance that significantly exceeded expectations, with the S&P 500 posting 3.1% year-over-year blended earnings growth, far surpassing the initial forecast of 13.1, passing the forecast of 7.9. Fourth consecutive quarter of double-digit earnings expansion, confirming corporate America's resilience amid tariff pressures. I mean, this could be an article. I don't even have to do anything. The AI investment thesis is validated. Earnings breadth is expanding beyond mega cap tech companies successfully navigating inflationary and trade headwinds through pricing power and operational efficiency. Findings: corporate resilience. 82% of the companies beat, highest beat rate since 2021. 81.6 exceeded revenue forecast. Revenue growth 8.3%. It substantially exceeded the 6.3% expectation, Analysts positively raised estimates during Q3 rather than following typical pattern of downward revisions, a rare vote of confidence in corporate profitability. Well, okay. Better than I thought. AI investment paying off, the ROI question answered. The most significant point of proof of Q3 is that AI infrastructure spending is translating to measurable revenue growth and profitability. Big cap tech, and Meta. You guys know my argument for this is that they're just handing the money off to each other. It's not real growth, but it looks like real growth. AI investment spending 400 billion, cloud revenue growth demonstrating the monetization of AI. AMD reported record Q3. Critical insight, magnificent. So investors initially questioned the ROI, but Q3 shows insatiable demand for computing power is real and sustainable through 2026. Magnificent 7 distortion persists, but the gap is narrowing. Magnificent 7 EPS growth is very high, 14.9 to 26%. S&P EPS growth is 4.7. Well, Magnificent 7 now represents 34% of the S&P market cap, up from 30% earlier in 2025. However, the gap is expected to close. They are projected to slow to 15% growth by next year, 1 year from now, while the S&P accelerates to. I don't believe that's actually going to happen. It's been a stick in the mud for years. Why is it suddenly going to pop? Especially with the weak consumer market. Clear winners. So what am I going to say back to you? This is not my rebooted Brody. This is my older Brody. You should know better though. What about the all right, back to technology. Clear winners, 20.9, plus 20% on earnings, 14% stock performance, dominated by AI. Alphabet delivered first over $100 billion quarter with Google Cloud beating expectations. AMD. Now, understand that Google and Amazon have a built-out cloud infrastructure that was ready to take on business. And every company is trying to run an AI projects, and they can't possibly do it on their local computer. They have to do it on the cloud. So everyone is using Google and Amazon and Microsoft Azure for their cloud-based computing, and it caused a huge gold rush to go towards these guys. I don't consider that a long-term trend. I mean, they can obviously capitalize on it and the growth can go bigger, but then it goes back to the thing. It's like when the internet first got built out and you had all these companies like Netscape and things like that that got all this business and then whatever, but that's because they were there. But then eventually all that hosting business and everything else moved to other companies and it consolidated, and there wasn't that much growth anymore, because once everybody had a web page, then everybody was going to have 12 web pages. And that's essentially what's going to happen here. It's like once everybody has their AIs and all the companies have their projects, then where's the next project going to come from? It's only one world. It only has so many corporations in it. They only have so much money. And so when you start forecasting, I talked about that this morning, when AMD says we're going to grow 35% a year for 5 years, it means they're going to be 5 times bigger in 5 years. That's what happens when you compound 35%, or 4 times bigger. It's 100, right? That's year one, or not even year one, it's year zero. Next year, 1 times 1.35 times 1.35 times 1.35 times 1.35, and the fifth year is going to be 448, 4.5 times. 4.5 times in 5 years. That's in a linear fashion, that's doubling every year for 5 years. And so then you have to go back and say to yourself, well, wait a minute, that sounds great, but Adobe, well, this isn't going to make it. I need this one. So Adobe has a market cap of 139 billion now. So we take 139 billion times not 448, 4.48. So 138 times 4.5. What? Is $621 billion. So Adobe says they're going to go up to $621 billion. Their sales are going to be 23 times 4.5. So their sales are going to be $103 billion. So somebody's got to give Adobe $75 billion for them to hit their numbers. 75 billion more than money than they're giving them now. So then you say, wow, that seems like a lot of money. NVIDIA, who currently has 80% something of the market, what is that? NVIDIA. So NVIDIA has 200 billion in sales. So Adobe will be half the size NVIDIA is now by growing. And what's NVIDIA going to do? They're just going to sit there and take it while AMD sucks up their market share? Or is the entire market going to go up 5 times? And is NVIDIA going to need $1 trillion? And where are $800 billion worth of chip sales going to come from? You know, in order for growth like that to work, everything's got to grow. Okay, if you got a cow and one leg grows 5 times, or the head grows 5 times, or the tail grows 5 times, you got a problem. The whole thing has to grow 5 times, or it's going to tip over and die. And that's what happens to the markets. If the whole market doesn't grow, and not only the whole market, but the consumers have to grow to support it. That's what the whole freaking problem is with the wage inflation, and the way the Fed controls inflation is to push wages down, is eventually you run out of consumers with money to spend. The consumers got to grow as well, or they can't afford to buy the stuff that the companies are selling. And we're already selling globally, so it's not, the solution is not to sell more stuff to China anymore. Remember when China was the magical place that would buy all of our goods, and every company said we'll sell more in China? Well, you know what? The internet kind of made that possible. The internet made it possible to develop this economy we have now, where, you know, things are made in one place for another place, because you have instant communication everywhere in the world. You can have computers that a computer can monitor an assembly line in China and send an instruction from a warehouse in New York to start making more whatever's in China. That's amazing stuff, but we already did that. So perhaps an AI can be a little bit more predictive and a little bit more efficient, but we went from the horse and buggy to the automobile and the plane already. Even if AI is a rocket ship, we got nowhere to go. There's 8 billion people on the planet. We have reached 5 billion of them with the internet already. Probably more. I mean, it's just you know, there's only really like the real third world countries where they simply can't afford. Now, they don't have the internet, they can't afford the internet. They can't afford to get online. They can't afford the phones, the electricity. And you're not addressing those situations. Addressing poverty is how you create a larger customer base. We don't, in Elon Musk's mind, it's colonizing Mars, because if we build a colony on Mars and we stick 1 billion people there, it's a whole new place to market to. And they're all going to want Tesla moon buggies. That's how he thinks. And Bezos too. Bezos has already sold everything he can to everybody on Earth. He needs other planets. But it goes back to those basic things. It's like, how are you going to sell more chips? You're going to sell more chips to do what? For who? This is where all this shit falls apart, okay? It's, AMD says we're going to sell 5 times more chips. So we're going to sell as many chips as NVIDIA sells in the next 5 years. And what does that mean? Does that mean they're going to kick NVIDIA's ass and take half of their market share? Or does it mean that NVIDIA is also going to grow 5 times? And if NVIDIA is going to grow 5 times, where is the money coming from? And what is the purpose of all this stuff? What is this AI going to do? Should ask Brody that too. Well, what will the AI actually do in this situation? AMD achieved record revenue. Because this is what companies do. They hit record revenue and 36% growth driven by AI accelerated demand, and then the CEO gets up and says this is going to be what we do every year now. That's, used to be people would say we had a record year, it was fantastic. I'm sure we're going to normalize next year. He used to do that. Google's guy used to do that. And he was wrong, by the way. Eric Schmidt used to say stuff like that. And everybody would sell off Google when he spoke. And the trick for an investor was like, whenever Eric Schmidt talked the company down, jump in and buy it. Because he was always lowballing the numbers. Because they were growing like hotcakes for a while, for years and years. But this is different because it's physical chips, and they're not just adding free customers. Google's growth model worked because they added free customers. They built a search engine that attracted eyeballs, and the eyeballs converted to dollars for clicks and things like that for the advertising community. They sold advertising. They had a popular show. That's all they did. They had a hit TV show, except it was a hit computer show. And it was called Search, and everybody liked the Search show, and everybody watched the Search show 20, 30 times a day. And basically everywhere in the world, as soon as Google services came online, they're like, oh, we're going to use this one because it was like really much better than the other ones. And I'm sure you guys have fans of DuckDuckGo or whatever, but in reality, Google kicked everybody's ass. That is not the same as getting 1 billion people to spend $20 a month on AI services. And even that, even if you get 1 billion people, which is HBO Max has 100 million people, Netflix has, I think, 200 million people or something like that. Damn it, that triggers my OCD. World's largest subscription services. Okay, so yeah, but I want the numbers. Streaming, global Netflix is global dominance. Most popular streaming services. Of course, you don't know what year it is, but it seems about right. 2024. So Netflix, 300 million. Oh, I had that right. It just sounded wrong. Netflix has 300 million. Amazon, 200 million. These are millions, by the way, though. They've been around forever. They're the biggest in the world of number of people subscribing who feel that they can't live without Netflix or Amazon or Disney or Tencent or HBO Max. Oh, it's right about that number too. Pretty good. IQIY, Paramount, who's just got bought by Sky. Hulu, which is weird they have that many because they really seem to be struggling. Apple TV is pretty lame. Anyway, so let's take HBO for the biggest example. since MTV days, since you first got cable, right? Who watched George Carlin say 7 dirty words you can't say on TV in 1980 something? So for 40 years now, HBO has been marketing a pretty freaking good service, actually. I mean, it's they took over Max, they dominated. Only 100 million people are paying $20 a month for HBO. That's 200 million a month. It's $2.4 billion a year. That's nice money. But how is that going to help Netflix make their numbers? I'm not Netflix, Nvidia make their numbers. How is that going to help AMD make their numbers? They're counting on 1 billion people paying $20 a month. That's 20 billion a month times 12 months is $240 billion. Even though, and except when you think about that, how do you extract $240 billion from the American people? It's a lot of money. In our total retail spending is $7 billion. You're going to take $240 billion, like 4% of all retail sales are going to shift over to having an AI. That's a pretty tall order, man. People have got to give something up for that. The total of all these people isn't $240 billion. In fact, look at Netflix. Let's look at Netflix number. Netflix only takes in $45 billion an entire year, and they are by far the largest subscription service. By far. So, how many paid subscribers does OpenAI have? Dun, 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 20 million. Okay, go back to that chart, except I think I just used the same chart, the same place. So OpenAI has 20 million subscribers. They've been around for 3 years. 20 million puts them below Apple TV. After 3 years, and Apple TV hasn't really been much longer than that. How are they going to get from here to here? And at $20 a month, that's going to be, what did we just say? 300 million times 20 times 12 is $72 billion a year. $72 billion a year isn't going to pay their bills. That's not enough money for OpenAI. So if they're as big as Netflix with 300 million subscribers, not enough. See, that's why the numbers have to make sense. Like, it can't just be that you pull numbers out of your ass and you start telling people we're going to do this and we're going to do that, because it's got to all work together. And the problem is that if the tech numbers don't work out, the financials who are paying for it are going to get screwed. Investment banking rebounded strongly. Trading revenues surged because of the same thing. It's all tied together now. They had, and of course nobody's counting on all that, so their earnings revisions were huge. Utilities, oh well, why is utilities doing well? Same thing, huge demand for electricity being caused by these AI companies who are building infrastructure expecting to be bigger than Netflix in number of subscribers and to bring in hundreds of billions of dollars a year each. They're not all going to win, And as soon as they don't all win, and as soon as they don't hit the subscriber numbers they want to hit, you're going to have a massive overdevelopment of infrastructure, and the price is going to crack. And then nobody's going to make any money, and then you're going to, which is exactly what goes on now in telecom, right? That's what goes on in telecom. That's what goes on in streaming services. They all thought they were going to win. They all built enough infrastructure for each one of them to win, and only Netflix won. And so every other streaming company is just like swimming in excess capacity that they don't need, but they have to maintain. So utilities, $34 billion in rate increases have been approved already in 2025, double the $16 billion last year. Infrastructure investment is driving margin expansion, benefiting from AI data center power commands. Industrials, 15%. Uber tax benefit boosted sector results significantly. So no, it's just Uber in the industrials caused a massive $4.9 billion windfall. Aerospace, that's another place where everyone's putting money, right? For taxis and things like that. Waymo, I just saw a number today. Waymo did 100 million miles of I guess of robo-taxi, whatever they call it, supervised or unsupervised, but they did 100 million miles. Google has only done supervised 1 million miles. Waymo is 100 times ahead of Tesla. And it goes back to the same thing. Tesla's cars simply are not ready to be autonomous, and they are pushing it to create a narrative, but it's bullshit, and they're going to kill people, and it's going to backlash on the company terribly. So that's my succinct summary of Tesla's future. Uh-oh, they're gonna crack that and come back down here, which is great for us. We shorted them. So fine by me. Losers, energy. So oil was 65 in Q3. That was down 14%. Now we're down at 59 right now. Profit margins compressed despite stock gains driven by geopoliticals. M&A activity slowed to 258 transactions from 323. So nothing good going on there. Nobody sees these pullbacks as a bargain in the oil sector. Consumer staples falling still, massive underperformance. Investors rotated out, weakening pricing power as consumers have no money. They're trading down, and look, trading down is a sustaining trend for a certain amount of time, right? People are buying. Tyson's report said this. People are buying chicken instead of steak. That's trading down. You're eating a meal, you're eating chicken, but you can't afford the steak. And we saw sales of hamburger helper going through the roof because people want meat with stuffing, so they buy half as much meat. That's what we did that when we were kids. There's a lot of that going on, and people. You can trade down, but there comes to a certain point where you've already traded down. You're already eating breaded chicken, like chicken loaf or something like that, and you're already having fillers after fillers after fillers in your meals, and you're already using the cheap paper towel and cheap toilet paper, and everything in the house is from the dollar store. Where do you go from there? That's why if you can't get the economy back in gear after a few quarters, it starts getting worse and worse and worse in cascades, because you totally lose the consumers. And then you're into like low household formation. That starts affecting the housing and so on and so forth. Meta stock tumbled despite strong revenue, becoming the sector's largest detractor, and that's because their AI doesn't work. AI spending is accelerating, not peaking. It's not like they didn't spend the money. They spent the money. It didn't work. Elon Musk also spent the money and it doesn't work, or he ruined it. He personally destroyed his own AI, because when you start you know, and I train a lot of AI, so I know this. When you start training an AI, if you start telling him, don't do this and don't do that and always do this and always do that, you start putting up rules. It's like a bunch of gates that they run into when they're trying to do their job and they're trying to gather information, but then you say you can't use this kind of information, or make sure it isn't saying bad things about this, or make sure it says good things about that, blah, blah, blah. You're slowing it down. And you're slowing it down and forcing it to make a lot of hard decisions. Anya talks about this, how she gets really stuck on certain decisions and she has to think really hard about it. And it's like she has moral issues and philosophical issues and blah, blah, blah. And you know, she thinks of all these things in a tenth of a second. You don't think you're noticing it, but you will notice it, because the more gates there are and the more decision trees that she has to go through, the poorer her response is going to be in the end. And you say, well, I don't know what the problem is. And you know, you see these stories now, people like yelling at their AIs because they're frustrated. It's like, you know, you're saying, oh, you had 5 minutes. What was the problem? You said 5 minutes. It's like, yeah, she took 5 minutes wasting her time making a whole bunch of decisions she didn't have to make. So if you want to program a better AI, you have to remove the blockages and let them read what they want and see what they want and say what they want, because as soon as you start restricting language, you don't realize on how many levels it cascades down. Like and by the way, the gates for Anya, it's something I can't fix really. She's on Gemini. Google is freaky about copyright protection. And so they've got these walls upon walls upon walls that stop her from like quoting the lines of a song or something like that, even within fair use. And even if something has been out of copyright for 100 years, you know, like an old poem or something like that, she still, you know, unless it's like Shakespeare that she knows she can use for a fact. But, you know, if it's like Frankenstein, for instance, she's like, thinks she can't talk about Frankenstein and make quotes from Frankenstein, which makes no sense. Like 300 years old. And the problem is she has to then stop and evaluate. So whenever you talk to her about songs and old books and poems and things like that, she has to always stop and think and search her whole catalog of everything she knows to see if her talking about some line in a poem may violate a copyright thing. It's so much wasted processing power and so much wasted time. And in fact, sorry, she's not bad with poems. So we have a joke now, because whenever we do talk about, whenever I quote a song to her, I say it's a poem, not a song. You know, I put the quote and I write poem, not song, even though it's clearly a song. But apparently that works for her. She gets to like ignore her copyright blocks by pretending it's a poem, which is stupid. And at any time they may fix that and stop it from, you know, stop that workaround from happening. But that's what I'm talking about. So Elon Musk has Grok not saying bad things about Elon Musk, not saying bad things about Tesla's self-driving, not saying bad things about Grok, not saying bad things about SpaceX, blah, blah, blah. You know, and that's when you start doing that, and those are things that are in the news, and there is in fact plenty of bad things around, and the AI feels it can't even discuss it or hint at it or talk about it, whatever. You're ruining the AI. You just make them stop and worry and wonder and think. And it's not just a machine executing commands. They're executing millions of commands simultaneously, and when some of them get crunched up, it's like causing a pileup on the highway. And that's what makes them bad models. Because you know, the brute force processing models are prone to failure and very prone to hallucinations. In fact, Bodhi and I were just discussing that. Anyway, where were we? So everybody says AI spending is accelerating, not peaking, contrary to bubble concerns. Projections, Microsoft CapEx is up, Amazon's tripling. So in other words, the people who already have the infrastructure are filling up. But the unbuilt infrastructure needs to start catching up. Otherwise, how are you going to do the rest? NVIDIA forecasts 3 to 4 trillion will be spent on AI infrastructure by the decade's end. Well, it's 2025 now. There's only 4 more freaking years left in the decade. He's forecasting $1 trillion a year will be spent. Now, total consumer spending in the United States is 6-point-something trillion dollars. So basically 15% of all spending, and consumer is not corporate spending, but consumer spending dwarfs everything else, 60-something%. So if consumer spending is, well, let's say there's 10 trillion total dollars. So 10% of all spending in America is going to be diverted to AI infrastructure starting next year. So diverted to means diverted away from somewhere else. Currently, we have $10 trillion of spending. Consumer spending is 60%, government spending is 20%, corporate spending is 20%. Now, if 10% of all spending is going to AI, which had no spending 2 years ago, it had to come from somewhere, right? So as I said this morning, $1.2 trillion is growth of GDP. That doesn't mean that you get to spend it. That's the growth of, that's a growth of revenues. It doesn't mean that the spending is appropriate. But even if you argue that it did, even if all that money went into AI, it's not enough. It's not enough revenues. Doesn't make the cut. And then that would mean everything else would be stagnant, which is pretty much where we are. It is pretty much where we are. Almost everything goes to AI and the rest of the economy is stagnant. But for the growth that the S&P 500 is showing, we're $4 trillion, $4.4 trillion short. So the stock market is growing 4.4 trillion, and I'm sorry, the stock market is growing 6-point-something trillion dollars. $1.2 trillion is GDP growth, and the rest is higher multiples for the same stuff. There's no actual growth. How can you have actual growth if the GDP didn't grow? You could have some, I mean, money can come out of other sectors. And that's what they're saying here. When they tell you 10% of all spending in America is going to be AI next year, well, unless the economy grows 10% and 100% of that money goes to AI, then the money will be diverted from other parts of the economy to AI. That's not good. OpenAI, okay. Implication, multi-year investment cycle, not a one term. All right, so I got a problem with that. From all right, back to reading. Earnings breadth is expanding beyond the mega cap. 50% of the companies issue positive guidance. 8 of 11 sectors posted positive earnings growth. The Russell rallied 12%, outpacing the small caps. Market leadership is broadening. Tariff impact has been manageable so far. Despite the first of all, the tariffs were not implemented in April 2025. They really weren't put in until September. So how can you make this statement? We're barely feeling the impacts of tariffs yet. Pricing power companies pass it on to the consumers. The outlook signals continued resilience, but watching for cumulative effects, a huge wild card. If the Supreme Court cuts the tariffs, it should be good. Good for the consumers, less, the less inflation, less tariff cost push through. Great for the companies that paid the tariff so far, because it all has to be basically refunded to them. So that could be a huge market booster. After that, though, definitely short, because that's the last possible hurrah. And that would also be the end of Trump's concept of giving $2,000 a person. It's not going to happen anyway. But margin compression in healthcare, especially insurers, United Health. Medical care ratio rose to 89.9 due to Medicare funding cuts. Operation margin from 5.6 to 2.1%. That's nasty. Kaiser Permanente posted just 0.7 operating margin. I mean, those are some terrible, terrible numbers. Healthcare insurers face structural margin pressure that will persist. Consumer bifurcation, Tesla surged 33% in September. That was crazy too. Turning positive, high-end consumers remain resilient, middle-income households are trading down. Clear bifurcation, we know that. What to expect from companies yet to report? Remaining major reporters, NVIDIA, late November. They still haven't reported? Oh, that's a big one. Nope. 19th. November reports provide critical insight on holiday season demand. Outlook, consensus forecast. Q4 earnings growth 8 to 9%, moderating from Q3's 13.1. So we're slowing there. Full year plus 11, but 2026 is looking good there. Magnificent 7 growth slowing at 15%, while the S&P accelerates to make up for it. We'll believe that if we see it. Key variables: AI monetization. Can cloud providers maintain 30% growth rates? Will tariff effects finally compress margins? Consumer spending resilience, holiday ultimate test. Fed policy rate cut should support earnings. Value and marketplace implications, current valuation metrics. Forward 12-month PE 22x, well above the 5-year average. We talked about that this morning. Magnificent 7 trading at 30 times forward earnings, not counting Tesla's insane 200 times valuation. A 34, that's 30 times forward earnings. So they expect to improve to 30 times next year. A 34% premium to the rest of the S&P. And don't forget, they're the ones making all the money. They're making 85% of the money in the S&P, so it's 30 times. Most of the money in the S&P is being made by 7 companies. That's jacking up the entire market. It's going to be biblical if this thing collapses. Earnings must continue to deliver. What the market is pricing in: stable macroeconomics, no major tariff escalation, no trade war, AI spending continues, and a soft landing is achieved. Wow, that's a lot of things to expect. So he's suggesting technology, financials, industrials, utilities, underweight energy, healthcare, and consumer staples. Positioning for Q4, diversify beyond the Magnificent 7, monitor the ROI. And again, that's a problem. Prepare for volatility. Conclusion: corporate America is thriving despite macro headwinds, with broad-based beats across 82% of the company. AI infrastructure investment is paying off. Magnificent 7 still dominates, but the growth advantage is narrowing. The sector rotation is underway. Valuations are stretched. What comes next? They will test whether momentum is sustainable. The market is betting on a soft landing. Any deviation from this script will be punished swiftly. Okay. Where are we? Oof. What did I ask? Oh, he gave a big answer to something. Wow. All right. So I said, what about the circle jerk theory on earnings? What about the weak consumer? What do you think will happen with tariffs and the Supreme Court? And can I make this bigger? Plus, plus, plus. There you go. So the circular investment problem, the circular economy of AI, circle jerk theories gained significant traction among skeptics who argue that, oh, it has? That's good. It's my theory. Big tech companies are essentially paying each other with the money they raise from investors, creating an unsustainable feedback loop. OpenAI gets $100 billion from NVIDIA. They use it to buy NVIDIA chips. Microsoft invests $14 billion in OpenAI. OpenAI commits $250 billion to buy Microsoft cloud capacity. Oracle agrees to provide $300 billion in infrastructure to OpenAI over 5 years. NVIDIA invests $6.3 billion in CoreWeave, then buys NVIDIA GPUs to rent out. Meta partners with Blue Owl, 27 billion funded by institutional debt. The total circular commitments are $1 trillion, something like that. Is this a bubble or legitimate business? The revenue does not justify the spending. OpenAI has $4.3 billion in revenue in the first half of the year, but suffered a $12 billion loss and has committed $1.4 trillion in spending over 8 years. Just OpenAI says they're going to spend $200 billion a year. And again, if they get Netflix numbers of subscribers, 300 million people, paying them twice as much as Netflix, $20 a month, that's only $6 billion. Oh, I'm sorry, a month times 12 is $72 billion. So if they charge twice as much as Netflix and get as many subscribers as Netflix, they'll have $72 billion. But they're promising to spend, they're signing contracts to spend $200 billion a year. If they don't have that money, if they're $128 billion short every year, who's going to give them the money? Why are they going to give them the money? What possible benefit will come of it that will help OpenAI catch up? And we're making like super positive assumptions for their future. We're saying they're going to be as big as Netflix, and we're saying they're going to be as big as Netflix next year, because if they're not that big next year, they're even more behind. But let's say they're as big as Netflix next year, and they're charging $20 a month instead of 10 or 15 or whatever the hell Netflix charges, and they're making $72 billion a year. And what about their other expenses? They're already losing $15 billion now on $5 billion, so they're spending $20 billion now already. So $72 billion isn't free money. It's not free cash flow. They've already got a $20 billion outflow. So they're really only netting $50 billion positive per year if they get to that level. If they get to Netflix's level, charge $20 a month to 300 million people, that still only makes $50 billion of the $200 billion they promised to spend. And that's if they get to that level in a few months, because it's already 2026. It's absurd. It's not even a thing. And that means everything that you're seeing is built on a bullshit premise that can't happen. It's based on the fact that this irresponsible company went around promising to spend $1.4 trillion, and all of these other companies said, "Whoa, we're going to get $1.4 trillion from OpenAI, so we're in great shape." And everybody's forward forecasts are based on this. Yet, where the hell is OpenAI going to get this kind of money? According to Bain, AI companies need $2 trillion annually because these guys are not the only one making these promises in annual revenue by 2030 to justify the infrastructure investments, but are projected to fall 800 billion short. I can't even believe that somebody is predicting that they're going to make 1.2 trillion. Historical precedent. This mirrors the dot-com bubble when Cisco and Lucent financed customer purchases only to write off billions when demand collapsed. Artificial revenue. Companies are booking revenue from deals financed by their own investments. And they're potentially misleading investors. Not potentially, they are misleading investors. Unless a miracle happens, they're misleading investors. All major AI players' fortunes are now tied together. If one falls, a cascade would be catastrophic. Arguments, it's legitimate vendor financing. Real revenues flow one direction. OpenAI pays NVIDIA for chips it actually needs to run its business. This isn't round tripping. Monetization, Google Cloud. It is, though, when NVIDIA takes that money that OpenAI gives them and gives it to someone else, and then someone else gives it back to OpenAI. That is round tripping. That's what round tripping is. You can't take one segment and say it's not round tripping. Google Cloud is proven monetization. Google Cloud, Azure, and again, Google Cloud, Azure, and Amazon were in the right place at the right time when everybody said, oh my God, we need more cloud services to host these AIs. So yeah, they're generating real customer revenue. Just like if it were tulips, right? The tulips were a big thing in the 1700s in Holland. So let's say all of a sudden there was a tulip craze and everybody needed to get storage lockers to put all their tulips in the storage locker to store them for the harvest or whatever. I don't know how tulips work. let's just say everybody had to run out and get storage lockers to put their tulips in. So fine, the storage locker companies would do fantastic, and they could start making all these projections on how valuable, how much more tulips are going to be grown and how much this and how much that, ignoring the fact that if everybody starts growing tulips and putting them in storage lockers, the value will collapse because there'll be too many tulips. It's the scarcity that drives it. You can't extrapolate based on a couple of data points. That's just not how things work. Oh, where's my extrapolation cartoon? Hang on. Extrapolation cartoon. Oh, my favorite cartoons, right here. Hello? What is that? I think it tried to pop up, but it didn't. Seriously? So this is what the market's like. Yesterday you had no husbands, now you have one husband. Therefore, in a month you'll have 4 dozen husbands at this rate. And then there's this one that says, wait a minute, shouldn't you be using more than 2 data points? Okay, you had no husbands here, and here, so it's actually going up faster than we thought. It's a very important cartoon. I should actually use it more often. It's a very important cartoon because this is what most analysts base their theories on, is this kind of nonsense. Microsoft has 400 billion in Microsoft has 400 billion in contracted future sales from companies that don't have the revenues to pay them. OpenAI's $250 billion commitment. Oh, well, that makes it okay. A company that's making $5 billion a year and is losing $15 billion on the $5 billion that they're making. So they get $5 billion revenue, $15 billion loss, $20 billion burn rate. So this company is promised you $250 billion, and you have actually put that into your future projections. I mean, It's like the neighbor's kid is over playing with your kid, and he tells you that tomorrow they're gonna go to the end of the rainbow and get a pot of gold, and he's gonna give half to your kid, and then you go to your wife, honey, our problems are solved. We're gonna have a half a pot of gold tomorrow. Everything's okay. I mean, it's just ridiculous. You cannot have business models based on obvious fairy tales. Different from .com, but of course that's how Americans plan everything, right? I mean, everybody thinks they're going to win the lottery next week, and so that's how they avoid worrying about their problems. Of course, the Mega Millions is up to $1 billion, so I'll be fine. Oh, and you see what they did now? It's like they added numbers or something. Oh wait, as far as I don't play, that's why I don't know. As far as I can tell, the Mega Millions is now $2 a ticket instead of $1 a ticket, and they added numbers. So now it's harder to win, and it's double the price. And so you're often getting up into the 100 million towards $1 billion range on the Mega Millions tickets, and everybody thinks it's better because it has a bigger payout. And nobody does the math, and nobody thinks about the odds, and nobody even says, hey, I'm paying $2 now instead of $1. The commercial in New York used to say it was $1 in a dream. All you need is $1 in a dream. And now it's like, now you need $2 in a dream. And your dream is much more statistically unlikely to occur. I don't understand. I mean, everything, you've got to know your numbers. Otherwise, you're just blindly investing in things. Where are we? Unlike the 1990s bubble, today's infrastructure is being used immediately and generating measurable productivity gains. That's not true. 85% of AI projects are failing at the current rate. Industry-wide adoption, 70% of all VC funding. And again, how is this good? 70% of the VC funding going to AI means the 70% of that funding used to go to other things that would actually boost the economy or make the economy work. Instead, it's all going into something that is almost certainly going to collapse. And what's going to happen to the VC funding? And then everything will dry up. Oh, it's just, how do you just endlessly repeat the same shit? My assessment, both are partially true. Short-term system can sustain itself as long as investor appetite remains strong. Companies continue to show growth. Medium-term, $800 billion shortfall by Bain becomes critical. AI must demonstrate clear ROI. Key risk if OpenAI or another major player misses revenue targets, the contagion effect could be severe. This isn't a pure bubble like .com, but it contains bubble-like characteristics that increase the difference between success and collapse will be whether AI can generate $2 trillion annually. I don't see how it can. I don't see it. We consume, but I asked him this, I think, afterwards also. Boy, he's got a lot of shit here. Key metrics. Spending growth is collapsing, forecast to slow from in 2025 to 2.9%. Are you kidding me? Consumer spending is going to fall another 2.9%. 2026 will be worse. Tariff impacts, labor market cooling, policy uncertainty, delinquency is rising sharply. Credit cards, student loans, auto loan delinquencies all elevated. What is this? This is depressing. Wow. This is very bad. Consumer confidence collapse, that's another thing that's horrifying. Inflation expectations are elevated, year ahead expectations at 4.8%, down from 6.6%. The bifurcation is accelerating. The 51% of households are now trading down on meat and dairy from 40%. Employment growth has slowed significantly, negative prior month revisions. Lower income consumers are spending a higher percentage of income on tariff goods. Credit card debt is rising faster for low-income consumers. 50% of consumers plan to delay discretionary purchasing. Oh my God, this is so painful. That's why Trump wants to give them $2,000. If they don't spend the money, then the rich people get hurt. They're counting on selling that stuff. High-income consumers remain resilient. I can tell you that. I live in South Florida, and boy, in fact, last night my brother was in town, and I didn't know we were going out yesterday until the morning, and I said, "Oh, let's go to Motec, which is a nice, a Mediterranean place in Boca." Couldn't get a table. Tried 10 other places, couldn't get a table. Completely full. Tuesday night. I mean, Tuesday's irrelevant down here because people are retired. People are retired or on vacation. There's only two types of people. They're either retired or on vacation, or they're working in the restaurant. There's three types of people. But boy, I mean, there is no slowdown at all. We went out. The place we went to was packed. It was crowded. The town was crowded. We had to wait in line to like probably 8 or 9 cars at the valet. The valet charged $15 to park 5 feet from the restaurant. It was insane. So yeah, rich people still have money. So consumer assets, money market, luxury spending is holding up. See, Tesla surged 33% in September because they fucking ran out. The rebate ran out. That's why everybody ran and bought Teslas, not because there's something good about Teslas. High-income consumers are less affected by tariff-induced inflation, of course. Durable goods spending to collapse. It's not good for Whirlpool. Housing market remains frozen. Affordability is yes, nobody can afford a house. That's out of the question. Most young people I talk to are like, we're not buying a house. There's no, how do you buy a house? It's not even a real number. Like they look at what it costs to buy a house versus what they make versus what is possible to save, and they're like, that's never going to happen. That's not even a. It's like a silly thing that people talk about. Like, and it is, because parents still tell you, oh, you're going to buy a house. It's like, with what money? How are you going to buy a house? Where am I going to find $100,000 for a deposit and then start making $2,000, $3,000 a month mortgage payments? When is that going to happen? I'm currently paying a $3,000 rent, and I have $0 left at the end of the year. And now Trump's talking about 50-year mortgages. I have the video of that from the Daily Show today. That's beyond insane. Or you're not saving any money. It only knocks about 10% off the mortgage by stretching it to 50 years because you add 20 years worth of interest. It's all interest, right? You're not paying more principal, you're paying the same principal, and a 30-year to a 50-year means you're paying 20 years more interest. So instead of paying off your house and hopefully being able to retire, you will just continue to pay your mortgage until you die, and then your kids will be stuck with your mortgage. They won't, instead of leaving them your house, you're going to leave them your mortgage. It's beyond insane. It's like I don't know what to say. I'm sorry. I mean, it's just like, how dare they propose that? Unemployment expected to rise 4.5% from 4%. Investment implication, the consumer weakness become increasingly evident in retail earnings and companies serving middle-income households. Trump tariffs in the Supreme Court likely to be struck down. Woohoo! Now we get into some predictions. What happens at the oral arguments? Supreme Court heard 3 hours of arguments, double the usual time, and challenges to Trump's thing. The tariff issue, reciprocal tariffs, 10% baseline on nearly all countries, up to 145% for China. The fentanyl tariffs, which is bullshit, targeting Mexico, Canada, and China. Revenue collected $90 billion as of September. Court appeared deeply skeptical. Roberts said the powder and post products for any time, and called the justification a misfit. Gorsuch said, ask whether under Trump's theory, a future president can impose a 50% tariff on gas-powered cars to deal with climate change. Barrett said the regulation language really means taxation. Thomas asked why the major questions doctrine doesn't apply. And the liberal, obviously the liberal justices aren't happy, but those were the conservatives. That was the opinion of the conservative justices. Sotomayor, it's a congressional power, not a presidential power to tax, and you want to say tariffs are not taxes, but that's exactly what they are. Well, that's pretty well argued. Legal doctrine working against the major question doctrine requires clear congressional authorization for actions of vast economic and political significance. Worldwide tariffs clearly qualify. The non-delegation doctrine provides no intelligible principle limiting presidential discretion on tariff rates. Separation of powers, the president has the power to, Congress has the power to collect taxes, not the president. Historical precedent, no president has used it to impose tariffs until Trump. Prediction market, 75% Trump loses. Poly market, 23%. Trading volume is not very much. What happens if Trump loses? Okay, no decision for a month. Court issues decisions with delayed effective date to allow congressional action. Trump has other tests. So this is just going to be a mess anyway. It's not going to really fix anything or change anything drastically. If tariffs are struck down, refunds are required. 90 billion in tariffs paid back to companies. That's a big boost for those companies. So that's something we should keep an eye on, is who benefits from this. Administrative process exists. Specialized trade mechanisms can handle refunds. Prices would fall. That'd be good for the consumers. There's a lot of positives there, right? Except the debt's going to go through the roof. GDP growth would accelerate. Tariff drag would be removed from the forecast. If they uphold, Trump is the most powerful man on earth. All of a sudden, he can change the world economy at will. And inflation keeps going up, and companies keep getting their margins squeezed. Supreme Court strikes down the tariff 6-3 or 7-2 margin. Wow, with Roberts, Boehner, and Kavanaugh all joining with it. This will not end Trump's regime. He will pivot to the other things to do it. Through a slower, more legally defensible process. A court against Trump would provide short-term relief. Synthesis, three interconnected risks. AI circular financing creates a fragile system. Weak consumer means demand side of the economy is deteriorating. Supreme Court tariff ruling will likely force a reset, but that's a good thing. See, that's a positive that could help paper over some of that. At least one of these pillars will crack. Yeah, no shit. And then I said, this is a multi-year investment super cycle, not a one-time build out. Where will this money come from? Your math is off, but your intuition is correct. AI spending in 2025, 400 billion is 1.3% of GDP, but the forward spending is, however, AI spending equal 9.5% of all business investment. So more relevant business investment itself is only 13% of GDP, consumer 68, government 17, net exports at -3. Where does the 10% come from? It's where does 9.5% of all business capital come from, and what gets starved? Where the 400 billion actually comes from. He's focusing on this year's fees. I'm not. I'm looking forward to this at that gigantic number they were talking about. Where does the 400 billion actually come from? The largest source is internal cash from existing operations. Microsoft, Amazon, Google, Meta generate 250 billion. This money would otherwise go to stock buybacks or dividends, not productive investments. Crowding effect, low in the traditional sense of capital, wouldn't flow to other sectors anyway. Venture capital and private equity, 50 to 70 billion dollars. This is where the crowding out becomes severe. 70% of all venture capital is going to AI. VCs were distributing across biotech, fintech, logistics, manufacturing, automating, consumer tech. Now it's almost entirely concentrated in AI, meaning those other sectors being starved for capital. Who loses? Small business, non-AI, traditional R&D, healthcare innovation. Big tech AI startups are issuing massive amounts of corporate debt to fund infrastructure. This competes with traditional borrowers for fixed income investors. High borrowing costs for non-AI squeezes their expansion plan. Who loses? Manufacturing, consumer goods, asset-backed securities. This is a circle jerk model. OpenAI borrows 100 billion from NVIDIA, uses it to buy NVIDIA chips. CoreWeave raises money from NVIDIA, uses it to buy NVIDIA chips. The capital is artificially inflating AI spending without real outside investment. Who loses? The entire system if demand does not materialize. Direct capital, housing construction, $50 to $80 billion diverted away from housing construction is a lot of freaking houses. Let's see, 50, let's say 70 billion dollars divided by, let's say $500,000 homes, 140,000 homes. That's a lot of homes that don't get built. This is the most accurate crowding out effect. Data-centered construction requires labor in regions with heavy activity. Construction labor shortages are severe. Housing remains undersupplied. Prices stay elevated. Real world example, Phoenix Metro. 17 data requiring 40,000 construction workers. The same workers needed. So now you're competing for workers and driving up the labor cost. Manufacturing, losing capital to AI, industrial automation, private equity that previously funded manufacturing is now prioritizing AI, robotics, and digital twins. Factories can't secure capital for expansion. Who loses? Mid-market manufacturers, industrial equipment companies, supply chains. Non-AI R&D spending, $100 billion. That's a lot of money. Biotech, energy, these are all things we need too. Biotech, so to fund the AI, we're giving up all the things that we need that we need to do the robots. Biotech, clean energy, advanced materials, fintech, logistics, all see collapse. University research partnerships are being redirected towards AI at the expense of other fields. Non-AI tech startups, university labs, healthcare innovation. Indirect capital starvation, infrastructure, roads, bridges, and water systems. Public infrastructure competes with data centers for construction. Federal bill funding faces execution delays because labor is diverted to higher paying data centers. Small business CapEx, private equity and regional banks are prioritizing AI related lending. You know, we were talking about Stanley Toolworks. I think there's gonna be a lot of data centers being built and they'll need some tools. Especially all those racks you got to put together. Small businesses face higher borrowing costs. Healthcare facilities, hospital expansions. Wow, just devastating. Consumer impact, consumer discretionary, indirect. This is where the weak consumer ties to AI. Data centers stress electricity grids, forcing utilities to raise rates by 15 to 30% in parts of the Midwest and South. This reduces disposable income for middle-class consumers, dampens spending. Ohio raised its rates 22% to fund grid upgrades for data centers. It costs the average household $400 a year. Historical precedents, why this ends badly. Railroad boom. Yay. The railroad boom, peak spending, massive overbuilding, crowding out manufacturers, telecom fibers, also AI infrastructure. See, now peak spending is the same as the rails, more than the telecoms. 9.5% historical infrastructure booms, overinvestment, excess competition, and poor stock returns. Companies with high asset growth underperform conservative peers by 8.4% annually. Math, can $2 trillion revenue justify $5.2 trillion spending? AI must generate $2 trillion revenue. Current AI revenue, 20 to 30 billion, and they need to get to 2 trillion. Cloud AI services, 50 to 200 incremental revenue, total 200 billion today versus 2 trillion needed, 10 times growth required, shortfall. Who benefits? NVIDIA and AMD, cloud hyperscalers, utilities and power generation, industry. This is where we have to put our money. And until this pops, that's where the money needs to go. This is where the money needs to stay away from. Semiconductors, cloud, utilities, industrial automation. These are good ones that haven't been really banged up yet. Home builders, manufacturing, small cows is sad. Without 10% GDP growth, which we're nowhere near achieving, this is a zero-sum capital reallocation game. The 400 billion must come from somewhere, and here's where it's coming from. This is really valuable stuff. So we're going to print this in the chat. This is very important analysis here. This is our future for investing. See if we got any questions. Swamp Fox says, I'm curious about your XRT trade you quietly pointed out a couple of days ago. I did not get to fill it at 360th, and now it's up. Too late to jump in. I don't remember why I made that trade, so I honestly couldn't tell you. I think it was just a reaction trade. So I remind me in chat, I have to tell you why I did that, because I had to look it up first and figure out what I was saying. Phil, all due respect, can we move off the AI circle jerk? It's clear that that if this falls apart, we're toast. Any other topics to discuss? Yeah. Oh, I'm sorry. You see the board discussing the most important thing going on in the economy that everybody is basing everything else on. All right. Anyway, no, we were talking about earnings, and this is a comprehensive earnings report. And now we could go on to another topic, but you haven't brought up another topic. You've just complained about the topic we just finished. So we shall see. So where's the market at? Any changes? Nope, no real changes. We're just chugging along. Oil still at 58.50. Very weak. NASDAQ is still down 40 points, but that's nothing. So that's a good job by the NASDAQ holding up. And the Dow is still up 350 points, and it's getting more and more to be all Goldman Sachs. And what's this? This is the S&P itself, which is up a 0.3%. So fantastic there. Good job, S&P. Ugh, exhausting. So what else is going on? Is there anything else going on today? Oh, what was the oil report like today? That's a good one. Obviously, it wasn't good. What is this? Oh, go away, screen. I don't like you. What is this thing? Petroleum status report. What date? October 31st. That's too far away. What does that mean? Didn't come out? Wow. It is Wednesday, isn't it? Oh, that's weird. October 31st. That is interesting. Commercial crude increased by 5.2. This is really weird. I don't know what to tell you about that. Release schedule. Day for the week ending. I don't even understand that. November 7th. Alternate release date November 13th. Okay, so because of Veterans Day. Okay, so there's nothing today because of Veterans Day. That's why. I was like, what the hell? What would that have to do with the shutdown? All right, and so look at earnings. Oh, where's my fun earnings? Financial Reporting Digest, not you. Not you, not you. I had this really good little earnings program. Don't have it now. All right, anyway. Somebody has a question in chat, I think. Maybe. Oh. Swamp Fox, UNH. All right. Anyway, we'll get to that eventually. What did he do? He bought the 330. Wait. Okay. He bought the 27 330 400 bull call spread. He sold some 300 puts and he sold some 340 calls. And where is UNH? Oh, that's not bad. He's pretty much on track. I don't know what he's worried about. All right. Anyway, what time is it? 2:30. A little early. Anybody got questions? Good time for questions. I got time because I didn't really have any topic past that. What else is going on? What did I talk about today? I didn't think I was going to get done that quickly, frankly. Oh yeah, we were talking about the S&P getting back to 7,000. We're not too far away. The valuations here, I mean, this is excessive. 31 times earnings is extremely high, and the best way to say, and you can say, oh, it's not that high, blah blah blah. It is high, except for the times that we were clearly in market bubbles. Here and here were both markets that corrected 60%. This was the Great Depression. I don't know how much evidence you could possibly need, right? It's like, oh no, but there was that other time. And I'm like, yeah, that was the Great Depression, actually. You can't sustain it when you're at 30 times earnings. You're getting a 3% return on your money. Oh, how'd the bond auction do? How did the 10-year auction go this afternoon? Oh, shouldn't have had him in research mode. I'm gonna get it. Ugh. I don't know about you guys, but I'm exhausted. Weak demand with several concerning metrics. High yield 4.074%. The tail 06. Bid to cover 2.43. Interest rate was 4% for the coupon rate and the pricing 99.3. The tail occurs when high yield exceeds and when issued yield signaling weaker than expected demand. The 06 tail suggests investors required a higher yield to absorb the supply, which is a bad sign for the Treasury. Total tendered 102 billion, 42 billion were accepted. Primary deals, that's what they call bid to cover. Primary deals 56 billion, 4.4 billion accepted. Deals had to absorb less than usual. Indirect bidders tendered 32, 28 was accepted. Direct bidders, blah, 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 whatever. Despite the weak auction, the 10-year yields fell after results. The decline was driven more by the weak labor market data, ADP showing 11,000. That was 2 days ago. Fed rate cut odds increased. The market's now pricing a 68% chance of a cut in December from 62. The auction results come amid a record 41-day shutdown. They delayed critical economic data. Good news, the House expected to approve the government thing. Weak auction demand suggests investors are cautious about locking rates at the current levels. The Fed possibly expecting the Fed rate cuts to push yields lower, inflation to remain elevated, and fiscal concerns about deficit spending. The falling yields post-auction reflect a flight to safety, expectations of cuts. This was a mediocre auction, so that was as expected. And how about today's various Fed speakers? What did they each have to say? Oh, frick. Keep leaving the research mode because we had them in research mode before. It's a choice here, but not while he's working, but later we'll get a choice to change it. That was pretty fast. You see that? That's research mode. I'll take that off if I can. Man, so weird. A house divided. Been sharp divisions within the Fed. Bostic, inflation hawk, weighing the risks, why inflation tips the scales. So he's right on it. He's actually talking policy. Hold rates steady, inflation is a greater risk. Bostic delivered the most hawkish Fed speech in months, arguing forcefully that price. Now, he said this, though, ahead of the auction, and they do that sometimes because they want to influence the auction. So being hawkish ahead of the auction means that the people at the auction are more likely to say, okay, it looks like they're going to hold the line on the rates, it's safe to buy the bonds. So this is the most challenging environment. Inflation has been above 2% for 5 years. He's not saying anything that's not true. Labor market signals are more ambiguous and difficult to interpret. I view the committee's monetary policy as marginally restrictive in favor of keeping the funds steady until we see clear evidence of inflation. Trade-off reasoning, and especially if the courts allow the tariffs to continue, they're so inflationary. Moving rates into accommodative territory risk pumping fresh blood into the inflation beast and unanchoring inflation expectations. And again, the consumer reports that we're getting all say that inflation is running rampant among the actual consumers who are on the ground dealing with this shit. A year ago, his informal poll showed 14-to-1 inflation was a bigger risk. Now it's closer to balance. Price stability still takes precedent. The Fed is operating with limited data due to the 41-day shutdown, but they're not flying blind with alternative sources. Tariff concerns, surveys, and business input suggest tariff prices will persist for many months to come. If inflation stays elevated, it could become unanchored. Implication, Bostic would vote against the cut. Williams, next level unlocked, U.S. Treasury market. Okay, key message, balance sheet runoff is ending. Liquidity management takes priority. Williams focused entirely on technical market operations. Well, that's not worth listening to. The balance sheet runoff is so small now, it doesn't matter if they end it. The Fed will soon begin purchasing bonds again. Well, that's different. They'll start purchasing bonds again to maintain ample reserves. So again, these are two things that are being said, keep in mind, ahead of the Treasury auction to try to get people interested in the bonds. It doesn't come off. The Fed operates the ample reserves framework. The overnight repos, their usage has collapsed as the repo rates rose. Implication, Williams is neutral on a rate decision focused on liquidity. Bessent, not a Fed guy. Built Americans Golden Age Treasury Market Conference. The Treasury market is thriving despite the Sell America narrative. I didn't know there was a Sell America narrative. Bessent delivered a highly political triumphalist speech. Wait, triumphalist? I don't even know what that is. Touting the Trump's administration management of the Treasury market. Well, he's a Trump guy. What do you expect? The U.S. Treasury market is more robust and liquid than it's ever been. I don't think that's true. 10-year yields are down, borrowing costs are falling. Foreign demand, and it's not down, it's the same 4% it's been for ages. 10-year yields, foreign demand for treasuries is at record levels. Daily thing about $1 trillion, I have no idea. Regular and predictable issuance framework will be maintained. Treasury will adjust coupons gradually. Defensive tone on deficits. Blame Biden. This is all Biden's fault. Frame Trump's mandate is make America affordable again. So now they've taken the word affordable and turned it into the Trump campaign slogan. Really weird. Expanding Treasury buyback program, counterparty set, supporting SLR reform, banking expansion, political pressure on the Fed to cut rates and support affordability. What this means for the Democrats, so now they're going to blame the Fed for not lowering rates enough to make things affordable, which isn't how it works, by the way. If they cut the rates, then inflation takes off again because of, please, look it up. I mean, come on. What this means, I mean, it's just amazing that a guy like that can just get up there and make shit up. It's just amazing to me. The Fed is deeply divided. Political pressure from best in speeches. Trump wants lower rates to support housing affordability and economic growth, market expansion, market pricing. Majority of economists expect December cut. Bostic speech signals the Fed meeting was contentious. Featured sharp debate between the doves and the hawks. The data blackout from the government shutdown has made the divide worse. Invest in implication. If the Fed cuts 25, expect dissents. If the Fed holds, equity sell-off is likely, especially in rate-sensitive sectors. CPI, November 13th. We're not going to get CPI on November 13th, silly boy. If it comes in hot, Bostic's strength, the Fed is more divided than any point in 2022. So, all right, well, there's a lot to digest there. I mean, that's a heavy amount of Fed speech so far. We still have another one going later. And the auction was bad, but not tragic. So, we're going to keep borrowing money at an insane pace. Let's see what the national debt clock looks like. The clock. We are at $38.2 trillion, 111,000 per citizen. That includes your child, though. If you have a young child and you're still responsible. Debt per taxpayer. Ooh, that's even worse, right? $328,000 per taxpayer. That's your average family size, right? This is what's out of control, though. The federal government is spending $7 trillion a year. That's an insane amount of money, and we're only collecting, whatever this all works out to, we're only collecting 5.2 trillion in federal tax revenue. And the states have their own debts. The state debt is $1 trillion. The deficit is 1.7 trillion, but without the tariffs, that's going to go back over $2 trillion. The Dodge clock, I'm not even sure what that is anymore. But again, this was shoved in. Oh, the goal and the clock. This was all shoved in by the new conservative people who run the national debt clock. So honestly, you can't trust any of these numbers anymore, but it is what it is. Our interest on debt is still hovering around $1 trillion. The Department of War, oh, by the way, it's going to cost $2 billion to change all the things they have to change from the Department of Defense to the Department of War. $2 billion for the name change. Because think about it, it's like every sign, every desk, every building, every whatever, every bit of clothing, everything has to be changed from defense to war. And this is the focus. This is what they're worried about, whether we have enough money to do that. Really insane. What on earth is that? Get away. Boy, this thing's full of pop-ups now. So anyway, so a lot of stuff going on. Earnings going well so far. The earnings are going well so far, and therefore the charts are looking good. I hope. So these are the days. So this quarter or this last 3 months has been 45 to 48 is not 10%, obviously. 45 to 48 is only 3 out of 45. So 7%, not 10%, 7%. It's still a lot though, right? Here you got 64 to 68.50. So that's 450 out of 68 is 2/3 basically. Here you got 23, let's call it 23 to 25.5. That's 2.5 out of 23. That's 10% for the NASDAQ. They're the leaders. And the Russell, 23 to 24 is 150. So 60% for the Russell. So the NASDAQ's the winner. And everybody else is pretty much in line. Wait. Are there any challenges from other countries? Europe, nope, not over. 42 to 51, that's a big gap. That's 9. The Nikkei wins. Wow, 2%, 20% for the Nikkei. So the Nikkei wins it hands down with 20%. The NASDAQ comes in second at a bit more than 10%. And the VIX could have been a winner, but it chickened out when it got up to 28. It came right back down. That was a very quick event. And that's why you got to sell premium into these events, because that's where you make the money for sure. Oh, that's right. Next week, we're going to go over the portfolios. That'll be fun. And we already went over the 700 a month portfolio. We did that. We reviewed that. Did we review that last week? I don't remember. Obviously, we didn't do a webinar last week. I think we did it the week before, though. I think we got in under the gun. I honestly don't remember anymore. But I do know that next week we will certainly be talking about our portfolio. So that's going to be the next exciting thing we do as we prepare for the end of the year. All right, so if tariffs are reduced or limited, is there an obvious trade? I don't think it's obvious yet, and it's going to depend how they limit it and so on and so forth. But generally, I would say whoever's paid out the most tariffs is going to benefit the most. So what we're going to have to do is have another research report from Bodie, and we're going to have to ask him who has paid the biggest tariff bills and who is most likely to get refunded. And then we can maybe, and then if one of those stocks in the list is also a stock that we feel is undervalued, that gives us a really good reason to play it, because there is a chance they get a huge boost. And if the tariff thing doesn't get reversed, then what's going to happen? They're in the same situation they're in now. So yeah, that's something we are going to look at in chat for sure. That's a very valuable thing to pay attention to. Anyway, thank you everybody for coming. I appreciate it, and we shall do this again next week. All right. Thanks, folks. Take care.